formally start, we'll be covering volatile markets and how to surmount them. Anybody has any specific, topic or any specific domain that they want to be covered, or any insight or any anecdote that they want to share?
Anything regards to US markets?
That's one. Apart from that, anything else that US market is doing? I think something with respect to what is the current situation, the tariff question in these times. Anything else? Any insight anybody want to share? Any anecdotes?
So much of fluctuations in the index on a daily basis. How relevant it is for the actual realistic performances of the companies? Can some changes be there? So about in a company that they sometimes lose 100 points or other times they gain 100. Is this a realistic way of, as a layman, I don't understand the technical language of your
Sandip will take care of that.
How does it correlate?
Yeah, so it sectoral basis, which are the sectors will be affected most by this tariff war within India?
So US is one. I'm so happy that we are getting so much, questions. Probably we can keep our prepared questions on the backside. But just to get the understanding of the crowd, I believe everybody invests in Indian markets.
US stocks.
US stocks. Indian markets and US stocks. Anybody who invests into alternates also, like private traded, REITs.
Leads to Indian markets. Also, we can cover that how someone wants to invest in China markets. So today we have apps called to invest in US markets, but if we want to invest in it.
Because it's a very specific question, so can I take it on the side? Means after the event will be, any other? So I am assuming that everybody invests over here in Indian markets, and some invest in US markets also. But I could not see anybody investing beyond Indian listed markets. So like alternates, nobody, REITs, private traded. Great. Of course. Great. So I'll formally start the discussion. I'll invite Zaki to make the introductions and then we can take it from there.
A very good evening, everybody. So in today's dynamic financial landscape, market volatility has become a constant companion for investors, right? So whether driven by global economic shifts, domestic policy changes, or geopolitical events, volatility poses both challenges and opportunities. This session aims to decode the current market environment and provide strategic guidance on how to navigate uncertainty with confidence. To discuss the same, we have with us our host, Mr. Ankit Garg. He is the founder and CEO of Nivesh, a leading wealth management firm managing 900 crores of AUM across corporates and HNIs, dedicated to helping investors to manage their wealth with confidence. With over 12 years of experience in Indian and global markets, Mr. Garg has worked extensively across India and the UAE. He is a major in finance from IIT Delhi and has experience across oil, automobile and IT's industries before he started his career as a wealth manager. Joining him is Mr. Sandip Bansal. He is the Deputy CIO at ASK Investment Managers. ASK is India's largest discretionary PMS house, managing more than 25,000 across more than 10,000 clients. Mr. Bansal comes with 22 years of experience with more than 18 years in investment management. Sandip Bansal sir joined ASK from SBI Life Insurance, where he has been an equity fund manager and was head of investment research, leading research across asset classes. Sir has also worked on the sales side with UBS Securities and Kotak Institutional Equities. Before that, he was a business consultant at KPMG and also has banking experience with Citibank. So, Sandip sir is a chartered accountant, company secretary and an MBA from IIM Ahmedabad. Sir joined ASK in July 2021. Thank you, sir. Handing over the mic.
So Sandeep, 3 degrees. People, feel tired in 1 degree only. You did 3 big fancy degrees. So let's address the elephant in the room. Certainly tariffs and US and Trump. These are the trigger points. But let's start with the symptoms first. Volatility in Indian markets. So I'll just cite some numbers before we start the sessions. Since September, large cap index is down by 15-20%. Small and mid cap are down by 25-30%. As far as valuations are concerned, large cap is at long-term discount by around 10-15%. Small and mid cap are still at premium 10-15%. Those of us who could foresee this coming last year and shifted their money from volatile kinds of assets like small and mid cap to hybrids, or even from large cap to hybrids, could avoid these kind of corrections in their portfolio. But that's in hindsight. In
stage at which one is in one's life. In the initial stages, maybe though you would be a better advisor on this than me, but maybe in the initial stages one could have a higher allocation towards equity, and then as one moves on, depending on how equity has done in one's portfolio and what are one's life's objectives, one could have a slightly more allocation towards annuity streams or income streams which are more determinant in nature, and greater allocation towards fixed income, a bit of commodities, etc., etc. But allocation is always important, Ankit. It is not only during volatile times. Should one be taking tactical bets at all? The answer is yes. Why not? Tactical bets should always be, in my view, a relatively small portion of one's asset allocation. But what the tactical bet does, it helps one remain connected with markets, with different asset classes. It helps remain one involved in one's wealth creation journey, which is a very important thing. See, tactical is not always a good thing from a long-term wealth creation perspective, because tactical by definition is short-term in nature, and serious wealth creation actually happens only over the long term. But to remain connected, to have that emotional involvement, it is important to have some portion in tactical allocation as well. In volatile times, one should actually not think too much about tactical allocations, right? Let's say if you are seeing a lot of weakness, then yes, you might want to, take smaller bets on tactical side. But in general, the larger portion of one's wealth should always be in strategic asset allocation across different asset classes.
So let me act as the devil's advocate, and I'll slightly go backwards for this. So like we started in November 22, and at that point of time we took a call that small and mid cap are at 40% discount to their long-term valuation, so we should have allocation in multi-cap. Multi-cap in the sense you should have large cap, small cap, mid cap, all three. But somewhere in June 24 we took a call that now, markets valuations have gone haywire. Small and mid cap are 20-40% premium. So it's better to shift all the gains that you have made from small and mid cap to hybrid and sit on the fence and let's see how this volatility rolls out. And then once as they say, dust settles, then you have a reallocation or you revisit your asset allocation. So do you think it's more of a not only question of my asset allocation or my risk appetite, it's also a function of how market dynamics or market parameters or market sentiments are placed?
No, absolutely. Asset allocation is individual dependent primarily, but it also has to take cues from how the markets are. So let's say if a particular asset which I want to remain exposed to for the long term, which is let's say Indian equities, I would want to invest a larger portion of my wealth in Indian equities, that is fine. But at points in time, that allocation could overshoot because of higher valuations, or I might not feel very comfortable with that allocation. So should at that point of time I change my allocation? The answer is yes. One should do that. Should it be done on a relative active basis? The answer to that is also yes, but one should not be hyperactive about it. So only at points in time where you feel that, as you rightly pointed out, that valuations have overshot too much, they are far above historical levels, etc., and one has started to feel uncomfortable, then yes, those switches are necessary to be made. Is a larger portion of the investing journey and investing skill set. That is why investing is something which has to be learned. It cannot be taught, like any other art, sports, or anything like that. When you say about, asset allocation, fear, sentiments, etc., the way to think about it is that any asset you should actually allocate more towards when there is a lot of fear in that asset, right? Because then that fear, that lack of opportunity or visibility of opportunity in that asset class is already priced in, right? So let's take the various examples in the last 10, 15 years or whatever. If you look at COVID times, in 2020, did we know how 2021 or 22 would look? The answer is no, right? Sitting in our homes when there is no economic activity going on, stock markets actually were going up, right? Now come to 2016 when demonetization happened. Did we know, how exactly the Indian story is going to play out? The answer is no. In 2013, taper tantrums happened when there were talks of the Fed, increasing rates and rolling back QE, etc. Did we know how is it going to pan out? The answer is no. During the 2008 financial crisis, did we know that where we would be in 2010 or 2012? The answer is no. But in those points of time, a lot of pessimism was already factored into the asset class, right? So let's say, just for discussion's sake, let's assume I am a 40-year-old individual, and this is 2008, and there is a lot of pessimism. I want to remain invested in equities, but the whole world is collapsing. What I should be doing? I can reduce my allocations to equities tactically, right? I should never go zero in equities. I should not say that, the world is so uncertain, let me, sell my equities by 50, 60%, whatever. Why? Because if we look at all the instances in history, right, the bad times have actually turned out to be the best times to invest in. Let's actually not look at a very far away time. Let's look at 2022. In 2022, when the Russia-Ukraine war broke out in, let's say, Fed, and we were having, let's assume, the same discussion, right? And I could have potentially told you, this is the first time that war has broken out in developed world. Serious war after the Second World War, right? On one side, there is a nuclear armored country like Russia. On the other side, there is Ukraine, which is supported by another nuclear armored bloc like NATO. All hell is going to break loose, right? I think one should sell all exposure to equity and move everything to fixed income. Or there is going to be a lot of uncertainty, so it's best to be in an annuity-oriented asset class, right? The results would have been disastrous, right? But then what should I do? If I have that feeling that there is a lot of uncertainty and I'm very uncomfortable about it from an emotional standpoint, the best thing is to consult in your wealth manager, right? Because he or she would have a wider perspective of things, has seen that, is more in touch with experts, so would be able to guide you better. Maybe that was a time to put in money. But if still I am uncomfortable as an individual, maybe I can take out some allocation, put it somewhere else, because it's not good to make money or while losing one's sleep, right? It is also very important to feel comfortable with one's investments. Right? But at the same time, one should not be taking very big calls when one is feeling uncomfortable. It is important to consult one's advisor, and in equities at least, history has told us that in uncomfortable times, it's better to put in money.
Great. So now I think we should play to the gallery. Everybody want to have 1 point discussion, that is Trump and tariffs. So if you could, take us through about your views. Before that, I'll share some of my views on the same. So 2.2% of India's GDP is exported to America, including merchandise and services. So let's say 1% of GDP of India is exported to America. Even if it comes down by 5 to 10%, we are looking at 0.1% degrowth in our GDP. So probably we will come down from 6 to 5.9%. Comparative numbers for countries like Vietnam is 25%, Thailand, Malaysia have 10-12%. So do you think, as far as India is concerned, it's more hype than substance in this, kind of fears that has engulfed the market?
No, I think the fear is not all hype. So the fear is genuine. The way to think about it is, yes, India's exports are, let's say, around $77 billion. The worst case impact could be more than 5-10%, it could be 25-30%. A reasonable bad case impact on India, worst case kind of an impact would be, let's say, 30-40 basis points on GDP. That could happen. The bigger impact is going to come from the fact that entire world growth is going to slow down. Right? So that will have many indirect impacts on our GDP growth. So could that happen? The answer is yes. But having said that, let's it's not a very easy picture. It's a very complex thing. B, nobody has seen this before. This story has not played out before the way it is playing out now. So there are a lot of assumptions to be made. But let's try to look at it in a very simple basis. Firstly, India is perhaps going to be the least impacted large economy in the world. Why? Because we are a domestic oriented economy. Right? We don't have that many export linkages to the rest of the world. So A, that is a positive for us. B, falling crude prices is a positive for us. C, while there are a lot of near-term uncertainties, in the medium term, India is actually going to benefit. Because the way the world functions is, broadly speaking, the developed nations are the consumers, the emerging markets are the producers. This is the broad overall construct. I'm talking about trade only, I'm talking about goods only, I'm not talking about services. If we look at this construct, India has the largest, the youngest, and perhaps the lowest or amongst the lowest cost labor force in the world for the next 3 decades. That's a very long-term structural advantage that India has. Also, these are not political statements, but for the first time in our 77-year-old history, we are undertaking economic reforms that also manufacturing oriented for a continuous period of 10-15 years. It has never happened before. The biggest reforms happened during 91 to 96, but that was more the opening up of the economy, de-licensing, etc., etc. Then after that, we've seen reforms in blocks of 3 to 5 years. We've never seen a continuous period of 10-15 years of reforms. So that is also a big change as far as India is concerned. And as you rightly said, Ankit, as more higher tariffs are levied on other parts of the world, it is relatively more beneficial for India. But will there be no impact? The answer is no. There will be some impact. See, at the end of the day, US and China are the 2 largest economies in the world. The US is $28-29 trillion economy, right? Let's take it $30 trillion. This is a good round number to remember. The Chinese economy is roughly $20 trillion. In PPP terms, purchasing power parity terms, basically adjusting currency, etc., etc., the Chinese economy is actually bigger. It is around $38 trillion, right? Now, global supremacy is getting vacated by the US because US is saying, I don't want to remain involved in the various jamelas of the world. I want to worry about my own growth and all of that. And, China has emerged as a good economic power. Now, no king or queen vacates his or her throne without a fight. So China is going to fight. And when the Senapati or the key lieutenant or, a neighborhood king feels that he's equally big or powerful, he is also going to fight on, right? So China is in that situation. When 2 elephants fight, the grass does get impacted, right? But will we get obliterated? The answer is no. But will we get impacted? The answer is yes, in the short term. In the medium term and definitely in the long term, we will actually be beneficiaries. Why? Because both sides are going to pull us. Right? The US has, what will the US do is, their ultimate enemy is China. India is not a claimant to that throne. China is. Right? So, they will perhaps at some point of time they may get into a deal with China as well, but that's going to be later on. Firstly, they will strike bilateral deals with all other nations, right? So Vietnam, they've started, or at least noises have started. India is actually working quite a lot already in that direction, and India is very important to them from a geopolitical strategic perspective as well. One more point on this is, see, US cannot manufacture whatever it needs. It's just not possible. The approvals to set up a factory in the US, the construction period itself is going to take 2 years. Then to stabilize the production, ramp up the production is going to take another year, right? 3 years, and you just have 4 years of Trump presidency. What happens, what will be the policy of the next president, no one knows, right? when a business sets up a factory, it is for 20-25 years. It's not for 3-4-5 years, right? It's a very long-term, capital-intensive decision, and hence it is just not possible for manufacturing to move to the US. And honestly speaking, whatever China manufactures at the scale, at the cost, it's not possible for the rest of the world also to manufacture. So this is a very long drawn thing. I think a lot of things will settle down over the next few months. The markets will derive confidence as and when a few trade deals are negotiated, signed. Markets will start to feel, hey, this guy also wants to actually do business. He wants to get people to the negotiating table, etc., etc. So I think it's going to be volatile for the next few months. In our view, it's actually a good time to invest, as we've seen in the past as well.
So, 3 things from what you said. One, do you think in the fight of 2 elephants, third elephant, who is a smaller elephant and who is not part of the fight, may benefit? Second, you mentioned about least impacted. So I'm so glad you used this term, because this is what I'm also telling my clients. Ki India, comparatively speaking, we have got the lowest traffic imposition on us among all the major countries. Compared that we have got 24%, and China has got 104% now after recent ones. So in a way, it may happen ki the manufacturing shift to us. So do you think that India may rather benefit because of this fight? So this fight is between the biggest consumer and the biggest producer of the world. India is neither. So America's trade deficit is $1 trillion, which is almost 25% of India's GDP. China's trade surplus is $1 trillion, again, almost 25% of India's GDP. So can it be so that we rather, so the spectrum for us will be from least impacted to beneficial? Do you think that's possible?
I think that is highly likely actually. What will happen is that manufacturing, the move away from China is going to hasten, right? And China was also doing a lot of manufacturing through Vietnam. A lot of Vietnamese companies actually have Chinese investments. So all of that will happen from India. But honestly speaking, that's a slightly longer term view, in the sense that it will not happen over the next few months. It will take a few years for India also to establish manufacturing capabilities. But a number of good things have happened which we are not noticing in this mayhem. See, if you look at it, China also perhaps realized in advance what is going to happen when Trump comes in. So, they started working with us on the border disputes that we have been having, right? Because China and the US both need allies in this fight, and we are one of the most important allies that both of them would like to have. And we need to learn manufacturing from someone. When in the 1980s, China and India were at the same GDP per capita, we did not have great relations with the US then. So when US was outsourcing manufacturing, everything went to China, right? So China was taught manufacturing by the US in some sense. We need to learn manufacturing from someone, and maybe China is one of the most important sources to learn from that. So all of the world is going to go us. Secondly, we are going to see trade deals with other countries as well, right? It will be the UK, it will be the EU, it will be New Zealand, and many other countries. So that is also going to help us. The rest of the world, see, US is 28-29% of global GDP. Let's take 30% of global GDP. The rest of the 70%, many of them who can come closer, will start to work in a far more efficient manner. So over the medium term, if we just look beyond the next few months and we start to think about the next few years, India actually stands to benefit from this. So the total manufacturing GDP of India is $500 billion. The total manufacturing GDP of China is $5 trillion, 10 times, right? China is 1/3 of total global manufacturing GDP. And if this tariff thing wouldn't have happened, there were forecasts which suggested that it's going to become 45%. are actually 50% in the next decade or so. Right? Now that is no longer going to be the case, so the shift is going to happen towards countries like India.
So coming to some of the questions which were given by the crowd, we have addressed about volatility and tariffs also we have addressed. If you can talk about US markets, what will be impact on US markets? Last few days have been very tailspin kind of story, market going down by 5%, then recovering by 3%. But in long term, how it will roll out? And if I may ask you a very specific question, last few years have been about FANG, about Batman in US markets. So do you think it's going to be same theme coming days also, or the story is going to change?
So see, US markets are perhaps the most badly impacted markets because of this. Right? The other badly impacted market should be China, but Chinese markets, if we just ignore the run-up that happened, Chinese markets anyways were not doing anything for a long period of time. They'd already gone down. They went up, and because of this now they've come down. Right? But the markets which actually get truly impacted is the US. Why? Because for the US, now the chances of recession are extremely, extremely high. It will be very surprising that a recession does not happen in the US. Right? Obviously, some parts are going to be addressed by monetary policy. Now the Fed is going to ease at a faster rate, etc., etc. Plus, what Trump is going to do is there's going to be a lot of fiscal consolidation, in the sense that they are going to cut out fiscal spending, wasteful fiscal expenditure, which Elon Musk is doing. Plus, they are going to give tax cuts, which is going to boost the US economy. But the way it's going to play out, first, growth is going to slow down. Right? Then, the benefits of whatever Elon Musk is doing on government efficiency, that is going to play out gradually. And then tax cuts will also give some extra dollars. But, likelihood of a GDP growth slowdown is very, very high in the US. But in equities, interest rates play a very important role. See, when rates go down, equity valuations go up, right? Risk on sentiments go up. So I think there could perhaps be a bit more pain in the US markets. And then things, once they start to negotiate trade deals, things are going to settle down, markets will get confidence. Then if the Fed starts to cut, maybe from the May meeting, etc., then, the markets will start to benefit from that.
Well, now try to paraphrase Milap sir's question where he asked, how does it happen that overnight market, companies go up and down. So probably what he is trying to say, sir, correct me if I am, wrong on this, that we understand that sentiment is wrong and all, but how could it be that a company goes down by 50% in a matter of 3 months, 4 months, and then they recover by 100%? So is it sentimental or there is substance to it? Correct, sir?
So can I add something here?
Sure.
Okay. I know very little about all these technical jargons. I'm a common man. I believe, Ankit, he takes good care of my work. But the problem is, every now and then, I'll take one simple example, Reliance, because I was associated with Reliance. One day I will see that the market, it says 3,000. Next day it will say 2,800. Next day it will say 3,100. And I know 3 days time, nothing happens in Reliance. So who does these things?
So before Sandip answers this question, I'll try to give my views on the same. That's why you require people like us.
No, that's fine. I accept, and we do have faith on you. But you need to tell us, why is this thing happening?
Sir, broadly speaking, there are three things that impact markets. One is fundamentals. Fundamentals take time to change. They change very slowly, unless and until there is a big shock. Suppose there is a COVID kind of a thing, right? Everybody is locked up in homes, economic activity stops altogether, then fundamentals also change all in one go. Tariffs are imposed, trade will stop, or come down substantially, fundamentals get impacted immediately. Otherwise, happen over a period of time. They are gradual. So they are a very important determinant of stock prices, But the most important determinant of stock prices in the long run is fundamentals. The second determinant of stock markets is liquidity. Liquidity has an impact in the near term, in the short term. FIIs have been selling, stock prices are going down. In a particular stock, if someone just wants to sell off because there is some redemption request and they want to sell out, it will immediately have an impact, right?
Can we say that the changes in the rate has got nothing to do with the efficiency of the company?
No, we can't say that. So I will come to that. The third important impact is on the markets is due to sentiments. Now, sentiments could be due to fundamentals. Let's say, suppose, in the case of Reliance, suppose they announce a new refinery. I'm just taking that as an example, right? While that refinery will take 5 years to build, earnings, profits are going to come 2-3 years after that, but market sentiments around the stock will improve because, growth outlook has gone up, etc., etc. Sentiments could be impacted by liquidity also, right? In the sense that, FIIs are selling, we don't know how long they are going to sell. Let's sell off everything, right? So sentiments have the third impact. Sentiments and liquidity generally have impact in the short term. The movement that we see in stock prices are more to do with sentiments and liquidity, more to do with news flow. News flow also has an impact on sentiments. So Russia-Ukraine, honestly speaking, the conflict was a relatively localized conflict. Hence, it did not have a wider impact on the rest of the globe. The tariff thing is a global thing, right? But Russia-Ukraine was relatively localized. But did it impact Indian markets? Yes, because there was a fear that, how far or widespread or how long it could go on, nobody knew, right? Over a period of time, sentiments, liquidity get taken care of, and fundamentals is what starts to matter. So that is why in the near term, it is very difficult to say anything about stock prices. If you ask me what is going to happen next month, honestly speaking, it will be very difficult for me to say. But if you ask me what will happen over 3 years, my confidence levels are going to be relatively high. Far
sentiments of a selected few people.
So in the markets, there are lakhs and lakhs of institutions, UHNIs, HNIs, retail. Everyone is participating in the markets at all points in time, right? And it's a very large market. Each individual, not maybe a retail individual, but each large participant or blocks of participants have the ability to impact stock prices, especially in the near term, right?
So before we move to next question, sir, so I think the mismatch is that you're looking at only one dimension, that is efficiency, but it's a multi-dimensional question. So lot many factors affect a business, and when business gets affected, its pricing gets affected, its valuation gets affected. So Sandip, next one, somebody asked about sector calls in these times. So what are your views on various sectors? What will be the impact of these tariff calls on sectors?
Sure. So, the very logical answer to think about it is that all export-oriented sectors should get impacted. All domestic-focused sectors should do well, right? So that is one broad construct to look at it. But within this, there are nuances which are involved. So in the domestic-oriented sector, banking is a sector which is domestic, but in banking, growth rates are not high. So even though it's a domestic sector, we would not be very bullish on banking per se. IT sector is an export-oriented sector. Will it get impacted? The answer is yes. While it does not have a direct impact because it's obviously not goods or trade, but it will have a second order impact because US economy itself is going to slow down. Discretionary spending or investments in IT by US corporations are going to slow down, and hence IT outsourcing to India will get impacted. The other important export sector from India to the US is pharma. Does pharma get impacted? Perhaps yes, but our view is that pharma is an essential. So even though it could get impacted in the near term, over a period of time, this is a product which no one else in the world can supply to the US at the cost at which we do. we are 50% of the generic market. About half of the generic medicines in the US are supplied by Indian companies. And at the cost and at the scale at which we do it, even China cannot do it, right? And because it's an essential, so I think that, even if they put in tariffs, I think it's going to get negotiated. Automobiles, auto ancillaries is an important export for us to the US. Would it get impacted? As of now, the understanding is that for the entire world, the tariff is around 25%. So we get as much impacted as everyone else. So unless and until US consumers stop to buy cars, there is essentially no impact. But will there be some impact? The answer is yes, because demand over there is going to slow down. But we are not relatively worse off versus the others. In the domestic oriented sectors, if you look at it, sectors like infrastructure, manufacturing, those sectors, because of the growth slowdown of the last year, valuations are quite attractive. So those are domestic oriented sectors, they will do well. Specific pockets in consumption like discretionary consumption, in our view, will continue to do well.
So Sandeep, there are times when you get a WhatsApp forward and you feel that it's a fake forward, and to the amazement it turns out to be correct. So my favorite one in last 1 year is when 2 motorcycle showroom owner, somebody who owned only just 2 showrooms of bike, raised an IPO. If my memory serves me right, the top line was 12 crore, and he was raising 12 crore. The issue size was 12 crore, and application was 4,800 crore. And one of my favorite books is Art of Thinking Clearly, which talks about 99 biases that we all suffer from, typically speaking. And one of the biases is cherry picking. That we cherry pick some data and we start, rolling it out as if it is correct. As wealth managers, we keep on listening from people, उस stock में इतना लगाया था, इतने का इतना हो गया, इतने time में. The problem with this kind of, with these kind of news is that people start feeling that this is a good segment to make overnight kind of money, and this is something that anybody can do. So, coming to the specific question that somebody asked, is how do you look at IPO and valuations of those companies? So, whenever there are corrections in listed markets, IPO numbers keeps on going down, and that is what has happened. If my I think last year there were some 100 IPOs. This year up till now there is only 15. And volume wise also I think they are only a quarter of what was happening last year. So what are your views on the valuation side of IPOs? And do you think now there will be more sanity to the valuation part of IPOs and on the volume also?
Yeah, so Ankit, firstly the example that you took was more on, was an SME company. Honestly speaking, in the SME IPO market, the craziness levels were quite crazy. I mean, it was berserk. I don't know what was happening over there. So it's a very illiquid market. How things work. At least we don't have an understanding about that because we don't invest in SMEs. Yes, I would agree that IPOs in general, the number of IPOs, the quantum of money raised, typically goes up in bull markets because at that point of time the sellers get a good price for what they are selling, the investors are more willing to invest in, and generally the economy etc. is also doing well at that point in time. So we at our end we did not participate. We participated hardly in a few IPOs because we are very careful about valuations at the time of investing. But yes, activity levels will come down. More sanity will prevail in the market, which is a good thing. The valuation ask is also going to be far more reasonable. I think in IPOs it is important for corporates and sellers to leave some money on the table for investors. And I can tell you with the experience in markets that I have had, that investors never forget. They always remember bad promoters, bad sellers, or if they've been taken for a ride. So if a company needs to maintain a healthy relation with the market, it is important to be fair to everyone. So yes, capital raising absolute numbers will come down in this kind of a market environment because everyone is going to be far more cautious. But people who genuinely need money and who want to be fair to investors and come in at reasonable valuations, I think that there will be investor appetite to invest in such businesses. Because see, at the end of the day, everyone wants to own a good business. And if a good business is coming at a good, attractive valuations, then a person, irrespective of near-term sentiments, would take a longer-term call and would like to invest in it. Yes, so valuations will become more normalized, but the number of IPOs will come down.
So does that answer your question?
Yeah, I think thank you for the insight. But sir, do you think, just to add to that question, do you think the valuation norms should also be tightened by the regulator? So right now the way we see it is it's technically driven by registered valuers and merchant bankers, and hence the ask of the overpriced the figures. Do you think that tightening the norms will also be a good measure going forward, looking at the current norms?
No, that's a very good question. But honestly speaking, I feel that the role of the merchant banker, the corporate, and to an extent the investors is relatively more important here than the regulator per se. See, in terms of regulation, honestly speaking, we are a very well-regulated market, and some of the practices, norms, rules, regulations that we have in India are extremely good by any global standard. And it's not that highly priced IPOs happen only in India. I mean, they've been happening globally for a very, very long period of time. And it's more a function of market sentiment. And honestly speaking, the regulator might not have a very large role to play over there. I think it is more to do with human greed than anything else, right? So, but if a person has that long-term view and ably guided by the merchant banker, see, like we have wealth advisors, the merchant bankers are essentially advising the clients. But so if the advice is given more from a longer term perspective than a near term perspective, and if the corporate also kind of keeps the communication in terms of what is the growth outlook, what is the expectations of the business, etc., more within fair ranges. See, ultimately, if it's about the future, nobody knows exactly how it is going to pan out. But if the communication is relatively fair, if the advice is more long term, I think those are the things which are far more important. And see, ultimately, equities globally, and there's a history of more than 100 years, is cyclical, right? So there are periods of, very good sentiments, extreme greed, overvaluations, then normalization. So these cycles, they can never be completely wished away. They will be there. They are, the nature of the beast in some sense. And people draw lessons, learn from the experiences, then the normalization happens, then it's forgotten away, and then it again happens, right? But over a period of time, investors who've seen market cycles, their behavior, because they have seen past cycles, their behavior gets improved, and then
was how aggressively the shareholders of the minority shareholders is safeguarded, and India's ranking, global ranking of the same was 5. So that's one good validation. I don't remember which SEBI chairman was it, but this kind of question was asked to one of the SEBI chairmen also, and he or she replied back saying that it's not our job to do price discovery. It's our job to regulate the markets, but not price discovery. Now, let's take it in a very tactical manner. Let's say SEBI or whosoever does it, and they say that you can't do it for more than 30 PE, and there is demand in the market. So what will happen? There will be huge, humongous listing day gains. So at the end of the end of the day, it's all about demand and supply, which nobody can control. And ideally, I think nobody should also control. So before we move to what all strategies you manage and how do you manage them, I'll ask the crowd if they have any question. This is the discussion that we have until now.
Can we talk a little bit more on the manufacturing part? Initially, you mentioned that India is a good scene because we have a low cost. Probably it is wrong. Cost of actual production is much higher of Indian manufacturers than China. Two reasons: the way the labor is controlled and the way the labor is free here from the controlling point. Second reason is because of the large manufacturing got established in China. Same scenario to happen here will take much longer time unless government really thinks about it. That too much of protection to the labor never helps the manufacturing. Second part was why we reached to this stage. If you remember the time of Y2K, long time back, suddenly a lot of workforce who knew a little bit programming increased very high, and government started getting a lot of export value wise, and the focus moved from manufacturing to the services. This is a very important reason to check. But what is the solution? Solution is in the hand of the government, and that's why many MOUs get signed, but reality not happen. Because if the labor force is controlled by the government to protect them, then it's very, very tough. What are your views on that?
Sure.
So,
Yeah.
when it's possible,
Sorry, probably it is not the market point, but manufacturing is manufacturing.
सर कह रहे हैं कि मोदी जी ने सब कर दिया लेकिन लेबर रिफॉर्म्स वो भी नहीं ला पाए.
So Ankit, I'll answer your question. Observation first. Actually, labor is a state subject. So the central government has framed a labor code, and it is voluntary for the state governments to follow that code. I think a few BJP ruled states have kind of started to follow it. So on your observations and questions, it's great. Adjusted, China is better. See, what is going to happen is, if you look at manufacturing shifts geographies every 40-50 years. So manufacturing started in Europe, Industrial Revolution, etc. Then moved late 1800s, early 1900s to the US. After the Second World War, it moved to Japan. 1980 it moved to China, South Korea. Last decade it has been moving to Vietnam, Bangladesh, etc. The reason why manufacturing shifts every few decades is because the economy starts to prosper, labor costs go up, environmental standards become more stringent, manufacturing has to find a new home. The reason why manufacturing will now shift from China to India and to other parts of the world is not going to be due to cost, because we cannot manufacture at China's cost. And we will not be able to manufacture at China's cost, even in my view, even in the next decade. Manufacturing is now going to move away from China more from a risk management perspective, because the concentration in China is too much, while the trust in China is not as high. And especially that has happened post-Trump 1, after COVID, and now it's getting accentuated in Trump 2. Right? So risk diversification always has a cost, right? So but that higher cost one should be willing to bear. The world is now willing to bear that higher cost, and hence manufacturing will come to places like India. Manufacturing, I'll just complete this. Manufacturing started in China in 1980. even after 45 years it is growing over there. Manufacturing in India in true earnest, has just begun in the last few years, right? It's a very long journey. We've not even, begun that journey in the truest sense, right? So we do comparisons with China more from a longer term basis. It's a very long journey, right? It's a journey for the next many decades, maybe 5 years have gone, right? And the first few years are the most difficult, but let's derive confidence from a few facts. Fact is, if you look at whenever manufacturing picks up, there is a big government intervention that is required, because without it, it cannot happen. In India, the PLIs, the ease of doing business, the taxation reforms and all of that helps. Secondly, the proof of the pudding is the electronics manufacturing, mobile manufacturing and all of that. That has been a big success, which shows that India can also succeed in manufacturing. While that manufacturing is, honestly speaking, is essentially assembling. The value add in mobiles is less than 15% in India. It's actually more like 10%. The value add in China is 42%. Right? We have a long distance to go, but at least we've demonstrated success that yes, we can also do it. The third aspect on these labor aspects, see, now there is competition between various states. Right? Again, not making any political statements, but industrial summits used to happen only in the states of Gujarat. Then it came to Maharashtra. The three most industrialized states in the country are Tamil Nadu, Maharashtra and Gujarat. Right? Now, there are industrial summits even happening in UP to hai, even in Bengal. Right? Now, one could say that, lakhs of crores are promised, only hundreds are invested, but there needs to be a beginning made somewhere. Right? Now, even the eastern states have started to hold investor summits, which is essentially that, even politicians have realized that ultimately you need growth, and growth can come only from investments and from corporates, right? Now, let's say if there is a strike in a Samsung factory in Tamil Nadu, right, and the Tamil Nadu government does not resolve it, right, there will be a message from the central government to the Tamil Nadu government that you resolve it. Let's say they even don't listen to that because there are different political parties. Tamil Nadu government knows that if I don't resolve it in a certain time period, the third factory of Samsung will open in UP. So that is what interstate competition does, right? And I think it's picked up in a big manner. So all of us, because we have seen nothing happening for so many years, see, big changes are difficult. Believe me, when we say that manufacturing has begun in the last 5 years, let's not forget that at least 2 years were lost in COVID. Right? So it's a long journey. I think we've begun well. We started very late, but I think we are on the right path.
Thank you.
Not to say that a lot of things need to fall in place.
Sorry, just a small addendum to what you've said, right? So when you say there's lack of trust in China, where is it stemming from? Because the way I look at it is everybody's end of the day buying from China, right? Also, there are enough countries that are trusting the OBOR that they are building. So where is this lack of trust?
So, excellent observation. So honestly speaking, the world cannot survive without China. Nobody can survive without China. Why? Because China is the factory of the world. If 1/3 of global manufacturing GDP is coming from China, it essentially means that 1/3 of everything is coming from China. If you look at the base of medicines, APIs, chemicals, China is essentially a monopoly in that, right? What we mean when we say that there is lack of trust in China, it is essentially from the developed market perspective, the countries that have buying power. See, if you look at all of this, BRI initiative and all of the other measures, those are largely focused and accepted by countries in Asia, Africa, which do not have that much of economic power. The lack or the relative lack of trust is more from the developed world. That is why you would see tariffs on Chinese EVs by Europe, or you would see tariffs by the US on China, right? The only large economy, India and China have a history, so that is why, there is lack of trust. But I would not say it for the rest of Asia. What I said was more from the people or the countries that have economic power.
Supply chains can't be moved overnight. And if you remember, Steve Jobs once said that I can't move supply chain from China. I can't, move my production line from China to any other country. From those days to these days, Apple is saying he will manufacturing more in India. So India's mobile export last year were $2 billion, out of which $1.5 billion was Apple only.
I think that's more diplomatic than. Wouldn't you agree?
Well, I have only this much to say, but I'll
Sorry. I'll just address that. So you said that's more diplomatic.
I mean, Apple wanting to do things in India is, it's in my view, it's more for diplomatic reasons than practical reasons. When they know that there is a Southeast Asia, there is a China who can do it for much cheaper.
No, so as I said, so I don't think it is only for diplomatic reasons. From an economic perspective, it does not make sense to manufacture anything in any country other than China, right?
Yeah.
But from a long-term risk management perspective, the concentration risk is extremely high. See, when China closes down due to a COVID shutdown, right, or there is some geopolitical tension, let's assume China attacks Taiwan, right, and the US takes a stance that we want sanctions on China, like they put on Russia when there was this Russia-Ukraine conflict. What happens to Apple? Right? So from a strategic perspective, from a long-term perspective, right, it makes sense to have alternate sources. And see, everything cannot be driven by economic reasons alone.
And I think the part of the equation that we are missing now is tariffs. So manufacturing cost is one, lending cost is different. So manufacturing plus tariff is lending cost to US. So if tariff for India is 24% and for China it's 104%, so there is a arbitrage of 80%. So that's what is playing the game. So before we move to what all strategies you handle and how do you do it, any other question from the audience that we want to?
Gold as an asset class, all the alternative to equity. How do you see it?
So, see, we don't invest in gold, but I'm giving you my personal view, and Ankit would be a better advisor on this than me. See, I think barring a global crisis, the peak of the US has perhaps happened in some sense. So there is going to be de-dollarization. It's a very, very long-term trend. Perhaps it's not going to play out in my lifetime. We really don't know. It's going to take many, many years, decades to play out. But there is no global alternative. If we lose confidence in A, there needs to be a B to gain confidence in. There is no B. There is no other currency. The only other large economy which is perhaps a claimant is China, and as we discussed, the developed world at least does not have that confidence in China, and hence its currency cannot be the currency of the world. Now, when things are uncertain, we need something. We need confidence in something, right? That something perhaps is gold. And so to that extent, could gold do well over longer periods of time till some alternative comes in? The answer is yes. But so far gold has already done quite well. So could there be a pause, a correction, and all of that in the near term? Yes, there could be.
In fact, recently there was a downfall in gold prices also after tariff announcement. So what we are suggesting that there is a category of funds, multi-asset funds, which have got allocation across equity, debt, and gold. So as per their mandate, which is given by SEBI, they are supposed to have allocation across 3 asset classes at least, having 10% in each. So the beauty of this product is if equity is not doing good, money first flows to debt. If even debt is not doing good, when economy is in recession and all, then finally money moves to gold. Or if depression is there, then money moves out of the gold. So the beauty of this asset class is that fund manager can take a call on your relative allocation basis, his understanding of the markets and economy. So we started allocating that money, our clients' money in that asset class in the month of September, etc. Your friend can give you testament of the same. And since September, when markets are down by around 15%, Sensex and small and mid cap are 20% kind of down. This asset class is down by around 5-6% only. Another beauty of this asset class is because they have their gunpowder ready. So I feel that markets are very expensive right now, so my money is more in debt than in equity. So when markets go down, I can shift from debt to equity. And that's the reason, if you look at 2 COVID waves, this asset class has taken least time to recover from the downfall as compared to pure equity even. So that's my effort at answering your question. Any other question that we have?
Just one small, slightly parallel question, which is what's your take on the growth of retail investors? When I say retail investors, individuals directly either through Zerodha and the likes or through brokers investing in. What's your take on that?
I'll first cite some numbers.
Slightly 5 to 5 year window.
So because this is a very good number for our industry, before Corona, the number of mutual fund investors in India was 15 million. After Corona, it became 25 million. Now it's 50 million, which is still only 3% of India's population. The corresponding number for China is 13%. For America, it's 40%. Number of demat accounts in India is 100 million, like 10 crore. And they are multiple accounts. So there is no data on unique PAN number demat accounts. 50 million. The corresponding number for crypto investments is 150 million. So in an ideal world, most of the people should be investing into mutual funds, lesser people should be investing into direct equities, and even lesser people should be investing in assets like crypto. But in India, it's the other way around. Looking at crypto investors, there is a validation that in India there are at least 150 million people who can do online investment. Because in crypto there is nobody who will help you with form filling and all. So that means at least there are 15 crore लोग ऐसे हैं जो online investment खुद से कर सकते हैं. Out of that 15 crore, only 5 crore as of now are investing into mutual funds, which again is only 3% of India's population. In spite of the fact that in mutual funds, that is not relevant for this crowd, but in mutual fund, the beauty is that you can invest as low as 100 rupees. You can start SIP with as low as 500 rupees only. And nowadays, everything is online. Over to you, Sandip.
So, Ankit has given all the numbers. I think the number of retail investors participating in equity markets directly will go up. This is a thing that generally happens when an economy prospers. So we are a low income economy. We will become a middle income economy 20 years, whatever time frame it will happen. And during that journey, the number of retail participants into equity markets is going to increase, because equities as an asset class has demonstrated that it has the ability to give double-digit kind of returns over longer periods of time. And as prosperity increases, disposable wealth or investable wealth for individuals go up, and then they would want returns on that. So first person keeps money only in savings account. As income starts to come, then they first do fixed deposit, right? Then jewelry and all of that people generally have in Indian homes. Then they would want to invest in mutual funds. And once they started to make some money in mutual funds, get some flavor of markets, then retail investors would, let's say, want to test the markets directly in equity markets as well. A lot of what is happening with the discounted broking platforms is on the FNO side, right? Which is, they are using it more like online poker kind of a thing, right? That's more like a gaming thing rather than serious money making or wealth creation. So वो सब चलता रहेगा. I think that's a function of market cycle. Will it grow over the years? Yes, because India has such a large population of young people, and there is so much of news flow, so much of excitement. Everybody thinks that he or she can make money.
So typically in all countries of the world, people first move to landline, and from there they move to mobile phones. In India, we directly jump to mobile phones. It's same with equities also, all thanks to DIY, and the kind of trust that I can do everything without any advisor. So, it has happened that more people are investing into crypto and direct equity than in mutual funds. So, Sandeep, let's bell the cat. What are your strategies that you are investing into, and how do you manage them, and how you are managing them in current market conditions?
Sure. So, I'll take the second part of your question first, Ankit. Honestly speaking, our investing style hasn't changed in the current market conditions. We are long-term investors. When we say long-term, we mean 5+ years. But, these days patience levels in society has come down too much. As soon as we send a WhatsApp message, we want to see those 2 blue ticks. So we've started to say 3 to 5 years. But, when one is looking at equities, one should think 5+ years. Whenever one has a expectation of short-term returns from a long-term asset class, one is setting oneself up for accidents. When, where, how that accident will happen, no one knows, but it's bound to happen at some point of time. Everything good in life takes time. Good career, good education, good relationships. There is no reason to believe that good wealth is not going to take time to create. So in equities, patience is required. Equities as an asset class has the ability to give double-digit kind of returns over long periods of time, because there are only that many people that have the stomach for the volatility involved during the journey. We are cross-cycle investors, hence market conditions really do not matter to us. We are bottom-up stock pickers in the sense that there are, broadly speaking, 2 investing styles. One is top-down, the other is bottom-up. Top-down is when one looks at macros, one looks at trends, one looks at what is happening in the market and all of that. The second is bottom-up, saying that I am going to pick up strong businesses, whatever be the economic cycle, whatever be the business cycle, whatever be the interest rate cycle, whatever be the market cycle, the business has the strength to come out strong in a few years, and that business will grow and I will grow with that business. So that is the philosophy with which we invest. So honestly speaking, in the current market conditions, nothing much has changed in the way we invest. We are categorized as what is called high quality, high growth investors. We invest only in quality businesses. There are roughly 4,000 odd listed companies in India. Like any large data set, you can draw a normal curve. We invest on the extreme right side of the normal curve. So, we have a board approved list of only 300 stocks. So we are essentially investing, and out of those 300 stocks, our invested companies are less than 100. So across our entire AUM of more than 25,000 crores, we are invested in less than 100 companies, which may be less than 90. And we've invested only in the leading businesses of different sectors. And leadership is not market size. Leadership can be growth, it can be vision, it can be return on capital, it can be profitability. There are various metrics. Our principle is capital preservation first, because capital is the raw material for this business. If there is no raw material, then there is no finished product. And then one comes to equities for capital appreciation. If you just want to preserve the capital, then fixed income is the best asset class, right? So capital appreciation, capital preservation for us go hand in hand. Also, we invest only in quality managements. For us, the filtration criteria is we first choose businesses that are high quality in terms of management. Then they should be having strong competitive advantages. They should be having a high return on capital. They should be having low debt. They should be having high free cash flow generation. And then with all of this, they should be having high growth. So Indian economy, in our view, is going to grow at a roughly 10% kind of a nominal GDP growth rate. Few years it's going to be -1, few years it's going to be +2. Longer term, 10%. We want our businesses to grow their earnings at minimum 15%. Because growth, in our view, is a very important risk management tool as well. India is a high growth economy. There is no point in investing in also ran or low growth businesses here. growth also adds a lot of energy, a lot of newness, a lot of innovation in the business, which is good. So that is our broad philosophy in investing. So if you look at our portfolios, the earnings growth of our portfolios would generally be 40 to 50% higher than that of the market. The return on equity, the return on capital of the businesses that we invest in, or the portfolios, are generally 40 to 50% higher than that of the market. So, 2 or 3 strategies I would just like to highlight. We have one strategy, which is the Indian entrepreneurship portfolio, which is our flagship portfolio, wherein we invest in businesses which are at least 25% owned by Indian promoters. Then we have a thematic portfolio, which is like a business cycle fund of mutual funds, wherein we change themes every few years. We invest in businesses that are going to grow double the nominal GDP growth rates for the next 5 years or so. And we invest in those businesses for a period of around 2 to 4 years. So currently, that fund called the Lighthouse Fund is focused on manufacturing, infrastructure, power, and all of those sectors. These are themes which we believe are really long-term structural themes, which should have disproportionate allocations in client portfolios. Then there is one other fund which we are going to launch, which is called the Special Opportunities Portfolio, wherein which is going to be a limited subscription opportunity, because we believe that the next few months are really going to be an interesting time to put money to work, because sentiments are down, earnings are not going to grow well, and liquidity is also weak because everyone is cautious at the time of investing. Valuations have also become reasonable. So we believe that if one has a 4 to 5 year kind of a time horizon, it's a good time to invest money in a lot of stocks which are available at very high margin of safety.
So as we study a mix of science and art, so what we do now, so we have selection and rejection criteria. So first we get a data API from which we get certain data points on all the funds available in the market, and we do selection. And then after that selection, basis the composite score that we get, we do rejection basis certain subjective criteria. And for the algo, we have criteria like we'll look at performance parameters, upward capture ratio, downward capture ratio, look at risk return parameters like Sharpe's or Trino ratio. Then we try to quantify the expertise of the fund manager by looking at it how many of his decisions were able to generate incremental returns. And then we basis all this work, we make some baskets which have generated good 8-9% kind of alpha over the period of the last 5-10 years. So my question to you is nowadays when everybody is talking about algo, how much of, and this is going to be last question, how much do you think manual intervention plays a part?
So see, algos have their space. There is absolutely no doubt. There is a space for algorithm-based investing, quant-based investing, and that portion is bigger in developed markets than in India. So in India also they are going to play an increasing role as we move forward. This is not to say that active investing and manual intervention-based investing or active fund management by individuals does not have a very specific and important role to play in alpha generation. See, if at the end of the day everything is going to be done by algorithms, then there is just going to be one algorithm which is going to take over the entire market, right? Then there is no market, right? See, by definition, if there is one person or one algorithm which is able to make money at all periods of time, everybody is going to put money in that. Then how does it get money? Right? So, is that going to gain relevance? The answer is yes. But is bottom-up stock picking, long-term investing, and some of the aspects which help individual fund managers like ourselves, are they going to remain? The answer is yes. See, many a time there are just no numbers, right? let's take the example. I'm not suggesting a stock. Let's take one of the quick commerce businesses or food delivery businesses as an example. There were no numbers, right? How do you pick that? It is about visualization about the future. It is about understanding and appreciating the vision of the founder, and it is about having belief in the execution track record, or how businesses have been built, let go of, new businesses getting entered. And there are many subjective and finer aspects which actually cannot be captured in an algorithm. At some point of time, would someone be able to do it? If ultimately everything is going to be done by artificial intelligence, then we really don't know. But I think that manual intervention-based investing, active fund management is going to remain a very large portion. In fact, the largest portion in Indian markets for a very long time to come.
Thank you, Sandeep. So happily we overshoot the time by a good margin. I hope our portfolio's returns also overshoot like that. So thanks, and I should really appreciate the audience for being so patient, and because it's a very technical concept and still people were so engaging. So thanks everybody, and thanks Sandeep once again. So we can interact now that we after this session, and thanks again.
Thank you so much everyone for appreciating. Thanks.